there are things that happen that are going on right now that don't make sense. And we're going to get to it, because what we've seen this week is something that we've never seen before. I think we mentioned last week a term that many people probably haven't heard of yet, which is backwardation. And to kind of just put it in a nutshell, and then you can definitely, because you know a lot more about it, discuss what backwardation is. Basically, when the spot price or the cash price for any metal exceeds the futures price, that is what we call backwardation. And this time alone, the COMEX joined the London market, where the silver price structure has been in backwardation for the recent weeks. And when we have sufficient physical metals available in the market, the cash price or the spot price for immediate delivery is typically lower than the futures price, maybe by about typically 20, 30, 40 cents around there.
At least.
That's around that.
But it's the cash value of money. The further out you go, it's like lending someone money. If you lend someone money and they're going to pay you back immediately, there's not much of a vig. If you lend someone money and you're going to take it in 6 months, you should have to pay more.
Correct.
Right?
And when the spot price, what we've seen now, surges above the futures price, it's an indication that there's urgency in the market to source that metal for immediate delivery.
Right. The normal structure is called contango. And contango is when futures trade above spot, which reflects the cost of storage, reflects the cost of financing and insurance. And we are far from contango right now. We are, as you mentioned, in the biggest backwardation I've ever seen. It signals urgent demand. It signals depleted inventories. It signals a systemic shortage of deliverable bars. Give me my bars now. I don't want to take your promises into the future.
This is one of the things that I wanted to go over that you might say that, well, you might not be proud of me, who knows? But one of the things that I had researched when we were starting to look at the backwardation was in May of 21, the LBMA admitted that they overstated the London Vault holdings of silver by about 106 million ounces.
Yeah, well, they only have a free float right now of 140 million. So what does that tell you?
Well, around the same time, SLV silver holdings, especially in London, it spiked significantly when a lot of people, and David Jensen, give him the quotes on it, noted it. And he had actually said that let me just bring up his quote. He said, quote, "The demand for silver may temporarily exceed available supply that is acceptable for delivery to the trust. Authorized participants may be unable to acquire sufficient silver that is acceptable for delivery to the trust due to a limited then available supply coupled with a surge in demand for the shares."
You know when that happened? That happened actually in February of 21 during the silver squeeze. So much silver piled into, or so many people bought shares that they, over the weekend, State Street, which is BlackRock, changed the prospectus to basically say, yeah, there might be more demand than there is silver in the trust.
Well, our infamous leader just brought exactly what we're talking about. The question is, was the LBMA's 100 million ounce overstatement related to the 100 million ounce temporary spike in SLV's London Vault holdings?
Probably, and it was did
BlackRock issue SLV shares without
buying
it's
the numbskull that used to work for Goldman Sachs. His name was I forget his name, but he said that that the banks are the shorts, that they take the money or the metal that goes into SLV and they short it, which they should never do because it's a proxy. You would not short metal because the metal is supposed to be 1-to-1 for the shares. And if you're shorting the metal inside of SLV to drive down the price, you're in essence borrowing people's shares without their permission.
Correct. So that's listen, my take is it's a little bit more than coincidence. I don't think it's the alcohol talking.
No, not yet. Let me finish this drink.
Yeah,
it might be, but the delivery strain is extraordinary. In October alone, we've seen almost 15 million ounces that have been delivered into COMEX. And when you have a $3 spread between New York futures and the physical market, there's a big problem. There's a huge problem. Not only that, the borrowing costs. Normally, the lease rates are about 0.5%. Right now, they've gone up to 100% annualized. That's worse than any time in the history of the market.
I think you should delve in a little bit more on explaining how the lease rates work.
So if you're going to short something that you don't have, you have to borrow metal to sell. Or if you have to cover something with metal you don't have, normally you could lease it very inexpensively. Now you have to lease it at 100% annualized cost. It's putting massive squeezes upon the big banks, but look at it from companies like ours, okay? So if I buy 100,000 ounces over the counter, spot, right? If I buy 100,000 ounces, the only way I can hedge it is with the New York futures, with the COMEX contract. But if the COMEX contract is $3 back a spot, how does that work? It doesn't work. I'm hedging something $3 lower than what I have to pay for it in terms of over the counter. In other words, the futures are way lower than the physical. So I pay this physical for $10, but I can only hedge it at $7. That's a problem.
Let me start by saying that what's happening right now in the silver market doesn't make sense if you're looking at it through the traditional lens of modern finance. There are patterns forming that defy conventional logic, and if you're paying attention, you'll realize we're witnessing something that has never happened before, at least not on this scale. The mainstream won't touch it because they don't understand it, or worse, because they're too scared to explain it. But I'll tell you plainly, silver is flashing warning signs that something is breaking beneath the surface of the global financial system. Now, last week we mentioned a word that's still unfamiliar to a lot of people: backwardation. It sounds like Wall Street jargon, but it's actually one of the clearest signals that a market is under extreme stress. Here's the simple version. In normal times, the futures price of a commodity like silver is higher than the spot price, the price you pay if you want to buy it right now. That's because it costs money to store, insure, and finance that metal until the delivery date. Futures prices account for those costs, and that normal structure is called contango. But when things flip, when the spot price rises above the futures price, that's backwardation. It means people are desperate for immediate delivery. They don't trust the system to deliver later, and they're willing to pay a premium to get it now. It's a sign of urgent demand and tight physical supply. Right now, both the COMEX in New York and the LBMA in London are in backwardation on silver. That almost never happens in both markets simultaneously. It's not just a fluke. It's a sign of depletion. It means inventories are drying up and deliverable bars are becoming scarce. In a healthy market, the difference between spot and futures might be just 20, 30, or 40 cents. But today, that relationship has inverted by dollars. People are saying, "I'll pay more if you give me the metal now," because they don't trust that the futures contract will actually deliver metal later. This kind of move signals something deeper than just price action. It signals fear. The fear that the paper system that sets these prices is no longer connected to the real, physical world of supply and demand. If you're a large investor, or a refinery, or a mint, and you want to buy millions of ounces, you're starting to realize that the system is a house of cards. The deeper you look, the more obvious it becomes that there's far more paper silver traded every day than there is real silver in existence. Let's make this real with numbers. The LBMA, London's silver market, admitted in 2021 that it overstated its vault holdings by about 106 million ounces. That's not a rounding error. That's the equivalent of an entire year's production from several large silver mines. At the same time, the iShares Silver Trust, SLV, managed by BlackRock, had to quietly change its prospectus. Why? Because so many people were buying SLV shares during the 2021 silver squeeze that the trust couldn't guarantee it could actually acquire the physical silver to back those shares. In legal terms, they said, demand may temporarily exceed available supply. In plain English, they said, we might not have the silver. That was back in 2021. Fast forward to now, and the pressure is far worse. Demand for physical silver has exploded, while inventories have been steadily drained for years. India alone has doubled its silver imports, not in rupees, but in ounces. That means they're not just spending more money because prices rose, they're physically buying twice as much metal. In China, bullion dealers have nearly stopped selling silver altogether. The few who are still selling are charging $120 to $130 an ounce, more than double the Western official price. That's not a premium, that's an alternate universe. You now have two different worlds, paper silver in the West and real silver in the East. This growing divergence tells you everything you need to know. In the paper world, silver is supposedly worth $50. But in the real world, the market is saying, if you actually want to take it home, pay twice that. The futures markets, the COMEX and LBMA, were designed to control this very dynamic. They were built to absorb demand by issuing paper claims. But now, those claims are hitting a wall. And here's where things start to spiral. Dealers like us, who buy and sell physical metal every day, are caught in a bizarre loop. If I buy 100,000 ounces of silver over the counter at the current spot price, I should be able to hedge that position with futures contracts to manage risk. But if the futures price is lower than my cost, I can't hedge without locking in a guaranteed loss. That means the normal system of hedging breaks down. The futures market becomes useless for dealers, and once dealers can't hedge, they start to pull back. That's when you see the kind of announcement that came out recently from a major supplier. We are halting all transactions until we figure out the premiums and availability. When the market makers start freezing trades, you know something is seriously wrong. Now let's talk about the lease rates, the cost of borrowing silver. Normally, leasing silver costs almost nothing, maybe 0.5% annually. But right now, lease rates have exploded to double digits, and at times, over 100% annualized. That means if you want to borrow silver to short it, or if you need to borrow to make delivery on a contract, it's suddenly insanely expensive. This is not just a technical oddity, it's a sign that no one wants to part with their metal. Holders of silver are saying, "No, you can't borrow mine. I don't care how much you pay me." So what happens when the cost of borrowing silver skyrockets, when futures prices disconnect from spot, and when physical supply dries up? You get what's called a delivery strain, a situation where the number of contracts demanding physical metal exceeds the amount of metal available for delivery. It's like a bank run, but in bullion. And it's already happening. In October alone, nearly 15 million ounces were delivered into COMEX contracts. That's a huge number compared to available inventories. And remember, silver's global annual mine production is about 850 million ounces. That sounds like a lot, until you realize that at current prices, that's only around $40 billion worth of metal. To put that in perspective, Apple could buy every ounce of silver mined in a year and barely notice the expense on its balance sheet. That's how small this market is, and how easy it is to stress.